Gold has always been more than a shiny metal. It's money, insurance, and a hedge against uncertainty. Today, the market is moving in ways that could dramatically reshape its value. Even in everyday life, you can see the signs. For example, while at the dentist recently, I noticed a commercial on the television in the waiting room advertising companies that buy people's gold, silver, and luxury watches like Rolexes. These ads are small but telling signals. Companies are actively seeking physical gold from everyday holders, highlighting both the rising value of metals and the liquidity available in the consumer market. When people sell jewelry or watches, the metal is refined and re-entered into circulation, adding to recycled supply. While this is just a fraction of the global market, it reflects growing public awareness and slightly increases short-term availability for buyers. On top of that, social media trends are driving people to buy gold jewelry, chains, pendants, bracelets, often with the intention of reselling. These small-scale purchases and sales provide liquidity and act as early indicators of market sentiment. Even small movements like this matter in a market as constrained as gold, because every ounce that changes hands adds to the visible supply and can influence both pricing and institutional confidence. Meanwhile, larger players, hedge funds, asset managers, and banks are beginning to tiptoe into gold in ways that could have seismic consequences. Hedge funds, which manage around 5 to 6 trillion globally, historically allocate just 1 to 3% of their portfolios to gold. Big asset managers and pension funds, overseeing more than 120 trillion, typically assign under 1% to precious metals. Even commercial banks with trillions in assets rarely hold significant physical gold. But imagine if these institutions decided to deploy gold allocations within their typical ranges. The combined effect could be 1.5 to 2.5 trillion in new demand, equivalent to 12,000 to 20,000 tons of gold, or 6 to 10 years of global mine production suddenly being absorbed by the market. History gives us a sense of the impact. In 2008-2011, around $200 billion in ETF inflows helped push gold from $700 to nearly $1,900 an ounce, a 170% surge. Now picture 10 times that demand hitting the market at once. Prices could realistically skyrocket 2.5 to 3.5 times higher than today, potentially reaching $9,000, $13,000 per ounce before the market stabilizes. Adding to the picture, gold's market is notoriously illiquid relative to its size. Most of the above-ground stock, roughly 216,000 tons, is locked in vaults, jewelry, or held by central banks. Annual mine production adds only about 3,000 tons, meaning sudden spikes in demand can have outsized price effects. Central banks themselves are increasingly active buyers, particularly in emerging markets such as China, Turkey, and India. Over the past decade, these purchases have added tens of thousands of tons to reserves, both signaling confidence in gold and directly supporting prices. Div inflows also amplify this dynamic. Products like SPDR Gold Shares, GLD, and iShares Gold Trust, IAU, allow both retail and institutional investors to gain exposure without handling physical metal. Significant inflows into these ETFs can quickly translate into large purchases of bullion, tightening supply and pushing prices higher. Historically, major geopolitical events, crises, wars, inflation spikes, or currency devaluations have coincided with periods of elevated demand and sharp price surges. This shows that gold is not just a hedge against inflation, but also a safe haven asset in times of global uncertainty. Retail activity intersects with this institutional surge in interesting ways. The gold sold by everyday people, through pawn shops, online resellers, or companies advertising to buy jewelry and watches, like that dentist office commercial, provides additional supply, easing some short-term liquidity pressure. But if retail holders start hoarding instead of selling while institutions buy aggressively, supply could tighten, amplifying price spikes. In other words, gold's market is a dance between everyday holders and massive institutions. Social media trends, commercials, jewelry sales, and ETF inflows set the stage, providing small but visible signals. Hedge funds, banks, central banks, and asset managers, meanwhile, are poised to be the game changers. When these forces intersect, retail interest, institutional buying, and global macro events, the result could be one of the most dramatic revaluations of an asset in history. Disclaimer: this story is for informational purposes only. It is not financial advice.